The Little Book of Valuation, by Aswath Damodaran. Introduction. Have you ever looked at the price of something? A share of Apple stock, a new video game, even a simple cup of coffee? And wondered, where does that number come from? It can feel like magic, can it? A price plucked from thin air, decided by invisible forces in a world far away from our own. We're often told that investing is a game for experts, a complex world of charts and numbers that's far too complicated for the rest of us. We are cynics, as Oscar Wilde once said, who know the price of everything, but the value of nothing. But what if I told you that behind every price, there's a story about cash, about growth, and about risk? And what if I told you that learning to read that story, to understand the language of value, is not only possible, but is one of the most powerful skills you can ever develop? Today, we're going to open a little book that packs a mighty punch. It's called The Little Book of Valuation, written by a man who has been called the master of valuation, Professor Aswath Damodaran. This isn't just another dry textbook. Think of it as a decoder ring, a key that unlocks the secrets behind how companies are valued, how stocks are picked, and how fortunes are made. Damodaran believes that valuation, at its core, is simple. It's not some mystical art reserved for Wall Street wizards. It's a craft, a discipline that anyone with a little bit of curiosity can learn. And that's my promise to you in this episode. By the time we're done, the fog will have lifted. You will understand the two fundamental ways to think about value. You'll have the power tools of the trade in your hands, and you'll see how to apply them to any kind of company, from a brand new startup with a bold idea, to a global giant that's been around for 100 years. We're going on a journey to strip away the mystique and show you that value is more than just a number. It's the heart of how the world of business truly works. So, let's begin. Book summary. So, where do we start on this journey? With a simple, yet profound, idea. The author tells us that in the entire universe of finance, with its thousands of models and metrics, there are really only two ways to approach valuation. Just two. Get these, and you've understood the foundation of everything else. The first is called intrinsic valuation. Imagine you're looking at an apple tree. You want to figure out what that tree is worth. Well, you could estimate how many apples it's going to produce this year, next year, and for all the years to come. You'd also have to think about the risks. What if there's a drought, or a pest? You'd naturally feel that apples you get 10 years from now are less certain, and therefore less valuable, than the apples you can pick today. Intrinsic valuation is just like that. It says the true value of any asset, a company, a stock, a piece of real estate, is determined by the cash it's expected to generate over its lifetime, and how uncertain we are about receiving that cash. That's it. Assets that produce a lot of cash, reliably, are worth more. Assets that produce little cash, unreliably, are worth less. It's a valuation based on the fundamental, internal characteristics of the asset itself. The second approach is relative valuation. Now, let's go back to that apple tree. Instead of counting future apples, you could just look around the neighborhood. You see that your neighbor just sold a very similar apple tree for $1,000. And the person across the street sold one for $1,100. You might conclude that your tree is probably worth something in that ballpark. This is relative valuation. You're not looking inside the tree, you're looking at how the market is pricing similar trees around it. When you hear about stocks trading at 8 times earnings while others in the same industry trade at 12 times earnings, that's relative valuation in action. It's a comparison game. Now, some people are purists. They'll say only intrinsic value matters, that the market is often a madhouse and comparing yourself to your neighbors is foolish. Others say intrinsic value is an academic fantasy, and the only thing that matters is what someone else is willing to pay. But Damodaran offers a wiser, more balanced view. Why choose? The smartest investors use both. They look for companies that are a bargain based on their own cash-generating power, their intrinsic value, and are also priced cheaply compared to their peers. It's like finding that perfect apple tree that you know will produce fruit for years, and also discovering it's on sale for half the price of every other tree on the block. That's how you find a true bargain. Before we can start valuing companies, we need to gather our tools. Damodaran calls these the power tools of the trade, and they are the foundational concepts you need to grasp. The first, and most important, is the idea that time is money. $1 today is worth more than $1 promised to you a year from now. Why? 3 simple reasons. First, you'd rather have fun today than wait a year. Second, inflation will eat away at that dollar's buying power. And third, a promise can be broken. There's always a risk you won't get the dollar in the future. The process of figuring out exactly how much less a future dollar is worth today is called discounting. The rate we use to discount it reflects our impatience, inflation, and that risk. This simple tool allows us to compare cash that arrives at different points in time, which is the cornerstone of intrinsic valuation. The second tool is understanding risk. When you invest in a company like Disney, you're exposed to all kinds of uncertainty. Maybe their next movie is a surprise hit, or a total flop. That's a risk specific to Disney. Then there are risks that affect the whole industry, like a change in how people watch television. And finally, there are big, macroeconomic risks, like a recession or rising interest rates, that affect almost every company. A brilliant economist named Harry Markowitz made a groundbreaking discovery in the 1950s. He realized that if you hold a big portfolio of many different stocks, the company's specific risks, the movie flops and hits, tend to cancel each other out. For every company that has bad luck, another will have good luck. The only risk you can't get rid of, the risk that truly matters for a diversified investor, is that big, market-wide risk. Finance has a name for a company's exposure to this market risk. It's called beta. A company with a beta of 1 moves in line with the market. A beta above 1 means it's more volatile than the market, and a beta below 1 means it's more stable. This beta is what helps us determine the discount rate we use to value a company's future cash flows. Riskier companies, with higher betas, get higher discount rates, making their future cash flows worth less today. The third tool is a basic grasp of accounting. You don't need to be an accountant, but you need to understand the story that the financial statements are telling. There are 3 main documents. The balance sheet is a snapshot in time. On one side, it lists everything the company owns its assets, and on the other, it shows how it paid for them with debt or with money from its owners, called equity. The income statement tells the story of the company's performance over a period, like a year. It starts with revenues and subtracts all the costs to arrive at the final profit, or net income. And the statement of cash flows shows exactly where the company's cash came from and where it went. One of the most powerful ideas Damodaran introduces is to think beyond the accounting balance sheet and visualize a financial balance sheet. On one side, you have the value of the company's assets in place, its existing investments that are already generating cash. But right below that, you have growth assets. This is the value of all the future investments the company is expected to make. A young, innovative company might have very few assets in place, but immense value in its growth assets. A mature, stable company is the opposite. This simple framework helps us see that a company's value comes from both what it has and what it's expected to build. With these tools in hand, the time value of money, a framework for risk, and an understanding of financial statements, we're ready to value our first company. And we'll start where all value begins, with an intrinsic valuation of a solid, established business. Let's use Damodaran's example of 3M, the company that makes everything from post-it notes to industrial adhesives. When we do an intrinsic valuation, our first big choice is whether to value the whole business. What's called enterprise value, or just the slice that belongs to the owners, the equity value. If we value the whole business, we forecast the cash flows the entire company generates before any debt payments are made. We then discount those cash flows using a blended cost of financing that includes both debt and equity, called the cost of capital. Once we have the value of the entire business, we simply subtract the debt the company owes, and what's left is the value of the equity. Alternatively, we can value the equity directly. To do this, we forecast the cash flows left over for shareholders after all debt payments have been made. This is called free cash flow to equity. We then discount these cash flows at the cost of equity, the return that shareholders demand given the stock's risk. Done right, both paths should lead you to roughly the same answer for the value of a share. So what do we need to do this? 4 key ingredients. First, the cash flows. We need to estimate how much cash the business generates. We start with the company's operating income, subtract the taxes, and then, this is the crucial part, we subtract the money the company needs to reinvest back into itself to generate future growth. This reinvestment could be building a new factory or developing a new product. What's left over is the free cash flow to the firm. It's the cash the business is free to distribute to its owners and lenders without hurting its growth prospects. Second, the growth rate. How fast will these cash flows grow? We can't just pluck a number from the sky. The most reliable way to estimate growth is to look at 2 things: how much a company is reinvesting, and what kind of return it's earning on those investments. The formula is simple. Growth rate equals reinvestment rate times return on capital. A company that reinvests a lot but earns poor returns won't create much value. A company that reinvests wisely in high-return projects will see its value soar. Third, the risk. We capture this in our discount rate, the cost of capital. As we discussed, this is a weighted average of the cost of debt, the interest rate the company pays, adjusted for tax savings, and the cost of equity, which is determined by the company's beta. For a company like 3M, which operates in many different businesses, Damodaran calculates a custom beta by looking at the average betas of each sector it's in and weighting them. This gives a much more accurate picture of risk than just looking at the stock's past price movements. Finally, the terminal value. We can't forecast cash flows forever. It's just not practical. So, we typically forecast them for a period of, say, 5 or 10 years, and then we have to estimate what the company will be worth at that point. This is the terminal value, and it often represents a huge chunk of the total value. The most common way to do this is to assume that after the high growth phase, the company will settle into a stable, perpetual growth rate forever, a rate that can't be higher than the growth rate of the overall economy. We then use a simple formula to calculate the value of all cash flows from that point to infinity. Putting it all together for 3M in 2008, Damodaran projects its cash flows for 5 years, calculates a terminal value based on a stable 3% growth rate, and discounts everything back to the present using the company's cost of capital. After adding back 3M's cash and subtracting its debt, he arrived at a value of about $87 per share. At the time, the stock was trading at $80. This suggested the stock was slightly undervalued, but the difference was small enough to be within the margin of error. This is a crucial lesson. Valuation gives you a reference point, not a perfect prediction. Now, let's switch gears and look at the life cycle of a company, because valuing a young, hopeful startup is a world away from valuing a mature giant. This is where Damodaran's framework truly shines, guiding us through the different stages of a business's life, from cradle to grave. Let's start at the very beginning, with young growth companies. Think of a company like Groupon in its first year. It had an exciting idea and was seeing revenues, but it was also losing a lot of money. How on earth do you value a company with no profits and almost no history? This is the perfect storm for valuation. The past tells you nothing, and the future is a giant question mark. many of these companies won't even survive. This is where valuation becomes more art than science. The story behind the company becomes paramount. We have to shift our focus from what the company is to what it could be. Damodaran gives us 3 value drivers to focus on. First, revenue growth. We need to estimate how big the total market for the company's product or service could be, and then make a reasonable guess at what market share this little company could realistically capture. For a solar panel company like Evergreen Solar, the example in the book, this means estimating the future size of the entire alternative energy market. Second, target margins. The company is losing money today, but to have value, it must make money in the future. We need to look at what profit margins are earned by larger, more established companies in the same business and assume that our young company will, if it succeeds, eventually move towards that target margin. We have to map out a pathway to profitability. And third, survival. This is the harsh reality. Most startups fail. We can't ignore this. Damodaran suggests a 2-step approach. First, value the company assuming it does survive and become a successful business. Then, estimate the probability of failure. This can be based on historical data for similar startups. The final value is a weighted average, the value in success multiplied by the probability of success, plus the value in failure, which is often 0 for equity holders multiplied by the probability of failure. For Evergreen Solar, assuming a 33% chance of failure took the estimated value per share from 63 cents down to just 42 cents. It's a sobering, but necessary, adjustment. Now, what happens when a young company survives and enters its high-growth phase? It becomes a growth company. Think of Google after its IPO, or Under Armour in its quest to challenge Nike. These companies are no longer just a dream. They have real revenues and profits. But the big question now is, how long can they keep up this incredible growth? The key challenge here is what Damodaran calls scalable growth. A company that grew at 80% per year for the last 5 years is now a much bigger company. It's simply harder for a giant to grow at the same percentage rate as a dwarf. Plus, success attracts competition, which will inevitably try to eat into its growth. So, when valuing a growth company, we can't just extrapolate past growth into the future. We have to build in a declining growth rate over time as the company scales up and the competition heats up. The second value driver for growth companies is sustainable margins. When Under Armour first came out with its unique microfiber apparel, it had a niche market and high profit margins. But as soon as it became successful, giants like Nike and Adidas jumped in with competing products. The question for an investor is whether the company has a strong enough competitive edge, a powerful brand, a unique technology, a loyal customer base, to protect its profit margins as it grows. A company that has to sacrifice its margins to keep growing is not creating as much value as one that can grow while keeping its profits healthy. This is what Damodaran means by quality growth. Growth by itself isn't always good. Growth only adds value if the company is earning a return on its investments that is higher than its cost of capital. A company that grows by making bad investments can actually destroy value. For a growth company to be a great investment, it needs not just high growth, but high quality growth. After years of rapid expansion, even the most successful growth companies eventually mature. They become the mature companies of the world, the Coca-Colas and the Hormel Foods. They've been around for generations, their growth has slowed to match the overall economy, and they have long, stable histories. Valuing them should be easy, right? Well, not exactly. The biggest challenge in valuing mature companies, Damodaran warns, is complacency. It's easy to assume that the way the company has been run in the past is the way it will always be run. But what if the company isn't being run optimally? What if there's hidden value just waiting to be unlocked? This is where Damodaran introduces a fascinating concept he calls valuation Viagra. He identifies 3 areas where a mature company might have slack that, if addressed, could boost its value. The first is operating slack. Is the company managing its existing assets as efficiently as it could? Could it cut costs, improve productivity, or sell off underperforming divisions? For a firm that is earning returns on its capital that are lower than its cost of capital, improving efficiency can create a huge surge in value. The second is financial slack. Many mature companies are very conservative with their finances. They carry very little debt. But debt, used wisely, can be a powerful tool. Because interest payments are tax-deductible, debt is a cheaper source of financing than equity. By taking on a more optimal amount of debt, a company can lower its overall cost of capital, which in turn increases the present value of its future cash flows. Damodaran shows how Hormel Foods, with its very low debt level, could significantly increase its value per share by borrowing more money and moving closer to its optimal debt ratio. The third source of slack comes from non-operating assets, particularly large cash balances. A huge pile of cash sitting in a low-interest bank account isn't creating much value. In fact, if investors worry that management will waste that cash on a foolish acquisition, they might even value that cash at less than $1. In these cases, returning the cash to shareholders through dividends or stock buybacks can be a powerful way to increase value. The ultimate question is whether management will actually make these changes. Damodaran proposes a powerful framework. First, calculate the status quo value of the company, assuming it continues to be run as it is today. Then, calculate the optimal value, assuming all the slack is removed and the company is run perfectly. The difference between the two is the value of control, the value that a new, better management team could create. The stock price should reflect a weighted average of these two values, based on the probability that management will actually change. A company with an entrenched, underperforming management team and no chance of a takeover will trade closer to its status quo value. But a poorly managed company with activist investors knocking on the door might see its stock price rise to reflect the possibility of a value-creating shakeup. Finally, we come to the last stage in the life cycle: declining companies. These are the firms whose best days are behind them. Think of Sears Roebuck, a company that once dominated retail but has been steadily losing ground for years. Or General Motors in 2009, on the brink of bankruptcy. Valuing these companies is a delicate balancing act. On one hand, you have a business with shrinking revenues and falling profits. On the other, these firms often have very little need to reinvest, which means they can sometimes pay out huge amounts of cash to investors. The key question is whether the decline is a temporary tailspin that can be reversed, or a permanent slide into oblivion. For firms that are not just declining but also distressed, meaning they have so much debt they might not be able to make their payments, we need a special approach. This is where Damodaran's framework for distress valuation is so useful. We again use a two-step process. First, we value the company as a going concern. We assume it somehow pulls through, restructures, and gets back to health. This gives us the upside value. Second, we estimate the likelihood of distress. We can use the company's bond rating to get a statistical probability of default. Then, we have to ask, if the company does fail, what happens? The assets will be sold off in a distress sale, likely for pennies on the dollar. We estimate these distress sale proceeds. The final value of the company is a probability-weighted outcome. For Las Vegas Sands during the 2008 crisis, Damodaran calculated a going concern value of over $8 per share. But with a 28% probability of default, where equity holders would get nothing, the distress-adjusted value dropped to under $6 per share. It's a stark reminder that when you invest in a declining or distressed company, you're making a bet on survival. Beyond the corporate life cycle, Damodaran also takes us on a tour of special situations in valuation, where the standard rules need a bit of adjustment. Take financial service companies, like banks and insurance firms. Trying to value a bank like a manufacturing company is a recipe for disaster. For a company like Ford, debt is what it uses to build factories. For a bank, debt, in the form of customer deposits, is its raw material. It's what it uses to create its products, which are loans. The lines are blurry. Furthermore, concepts like capital expenditures and working capital, which are central to calculating cash flow for a regular company, are almost meaningless for a bank. So what do? We fall back on the simplest, most reliable models. We value the equity directly. And we often use the dividend discount model. For a regulated bank, dividends are a very honest measure of the cash that can be returned to shareholders. The key drivers of value for a bank are its ability to earn a high return on its equity, the amount of that equity it has to hold for regulatory reasons, and the riskiness of its investments. A bank that can generate a high return on equity without taking reckless risks is a bank that will create immense value for its shareholders. What about cyclical and commodity companies? An automaker like Toyota or an oil giant like ExxonMobil? Their fortunes are tied to forces far beyond their control, the ups and downs of the global economy or the volatile price of oil. Their earnings can swing wildly from year to year. Valuing Toyota at the peak of an economic boom, when it's making record profits, will give you a very different number than valuing it at the bottom of a recession, when it might be losing money. The solution is normalization. We have to look past the extremes of the cycle and ask, what would this company's earnings be in a normal year? We can do this by averaging its profit margins over an entire economic cycle, say, 10 years, and applying that average margin to its current revenues. This gives us a much more stable, reliable measure of its true earning power. For a commodity company like Exxon, we can value it based on a normalized price for oil, again, perhaps based on a long-term average. This removes the noise of the cycle and allows us to see the underlying value of the business. Finally, we have one of the most important and challenging categories in the modern economy: companies with intangible assets. Think of a technology company like Google, a pharmaceutical firm like Amgen, or a consumer brand like Coca-Cola. Their most valuable assets aren't factories or machines. They are invisible things: brand names, patents, technological know-how, and brilliant employees. Here, we run into a major problem with accounting. When a manufacturing company builds a factory, accountants rightly treat it as a capital expense, an investment that will generate benefits for many years. But when a company like Amgen spends billions on research and development to discover a new drug, accountants treat it as a regular operating expense, like paying the electricity bill. This is a huge distortion. It understates the company's true earnings, and it makes the company look like it has far less capital invested than it really does. Damodaran's solution is bold but logical. We have to fix the accounting ourselves. We must capitalize these intangible investments. For Rand, we can treat it as a capital expense and create a research asset on the balance sheet, which we then amortize over the years it's expected to generate benefits. When we do this, we get a much truer picture of the company's profitability and its reinvestment for growth. For Amgen, Damodaran shows that capitalizing its Rand expenses increases its estimated value per share from about $44 to nearly $63. It's a massive difference, and it comes from simply treating an investment as an investment. This journey through the world of valuation, from the simplest truths to the most complex cases, leaves us with a profound understanding. Value is not a mystery. It is a story, a narrative about a company's future. And like any good story, it has its key elements: the cash it can generate, the growth it can achieve, and the risks it will face along the way. Learning the language of valuation allows you to read that story, to question it, and ultimately, to write your own chapter as a more informed, more confident, and more successful investor. Commentary. As we close the pages of the little book of Valuation, it's worth pausing to reflect on the most powerful lesson it offers. And it's not a formula or a spreadsheet. It's a mindset. What Aswath Damodaran does so brilliantly is to democratize a field that has long been shrouded in mystique. He pulls back the curtain and shows us that valuation is not about finding a single, precise, correct number. The pursuit of precision, he argues, is a fool's errand in a world filled with uncertainty. Instead, valuation is about crafting a narrative. When you value a company, you are telling a story about its future. You are making assumptions about its growth, its profitability, and its place in the world. The numbers in your valuation are simply the language you use to tell that story. The real power of this process isn't in the final number you arrive at, but in the discipline it imposes upon your thinking. It forces you to ask the right questions. Can this company really grow that fast for that long? Are its profit margins sustainable? What are the biggest risks it faces? This is a profound shift from how most people think about investing. We often get caught up in the noise, the daily stock market chatter, the hot tips, the stories of overnight success. Damodaran calls us back to the fundamentals. He reminds us that behind every stock price is a real business, with real assets, real employees, and a real capacity to generate cash. The price can dance around wildly based on market mood and sentiment, but value is the anchor. It is the center of gravity to which the price will, eventually, return. So, how can you start applying this today? You don't need to build a complex financial model. Start simply. Pick a company you admire. It could be Apple, Nike, Starbucks, or even a smaller company you follow. And just try to tell its value story. Ask yourself: 1. What is its key to generating cash? Is it a powerful brand that allows it to charge premium prices? Is it a unique technology that no one else can replicate? Or is it incredible efficiency that lets it sell things cheaper than anyone else? 2. Where will its future growth come from? Will it be from selling more of its existing products, expanding into new countries, or inventing entirely new product categories? Be realistic. 3. What is the biggest risk it faces? Is it a new competitor, a change in technology, a shift in customer tastes? Just thinking through these 3 questions will put you light years ahead of the average investor. You will start to see companies not just as ticker symbols, but as living, breathing organisms with strengths, weaknesses, and a story to tell. That was a summary of the Little Book of Valuation by Aswath Damodaran. We've journeyed through the core principles today, but I'll be honest with you, a summary is like looking at a postcard of the Grand Canyon. It can show you the view, but it can't replace the experience of standing on the edge yourself. The real magic of this book is in the way Damodaran explains things with such clarity and patience. If any part of our conversation today sparked your curiosity, if you felt a little thrill at the idea of decoding the world of business, then I truly encourage you to pick up a copy. Reading it isn't just an act of learning, it's an empowering experience that can fundamentally change how you see money, business, and your own financial future. Also, if you found this summary valuable, and you're excited to explore another life-changing book from the Billionaire's Bookshelf, please take a moment to like this video and subscribe to the channel. It's the best way to make sure you don't miss our next adventure. Let's keep learning and keep growing together.